Dear students, welcome to the course of Marketing of Financial Services. We are in unit number 3. Topic is insurance, and subtopic which we are going to cover today through this video is life insurance. I have planned this video in two sections. Section 1 will try to understand what do you mean by life insurance, why it is essential, how should we calculate or know sum assured when we are going to plan for life insurance, and at the latter part of the video we will try to understand what are the different types of insurance available for us. Let us try to look into the first and a very basic term, that is, what is insurance. Life insurance is a financial cover for a contingency linked with human life. That contingency can be death, disability, permanent or temporary, accident, retirement. These are certain things which we need to cover for our future or in the present sense. And for that, we will try to have an insurance which is based on sum assured. That means that is an amount which is guaranteed to be paid in the event of loss is by the way of benefit. For example, it is talking about a financial cover for an individual for certain contingency like death, disability, accident or retirement. In simple, if an insurance is covering disability, if the individual is undergoing a permanent or a temporary disability, a financial cover is being given to that individual who has undergone an insurance. That is what is called as life insurance. Let us take into a very simple example. Vijay, a shopkeeper, has purchased an accident insurance of 5 lakhs. Now what is life insurance here? The sum assured is 5 lakhs, which would be a contingency provided in terms of accident and will take care of a financial cover which is of sum assured, that is of 5 lakh. Means that is a benefit which will be paid for a contingency which is linked to a human life, and that contingency can be death, disability, accident and retirement. Now the second question comes in, this is called as life insurance. The question that comes to our mind would be, why should we buy life insurance? Is it necessary to buy life insurance? Surely. Why should we buy life insurance? Point number 1, life insurance will ensure that immediate family has some financial support in the event of demise. Suppose individual X is the financial support to the family and something untoward happens with that individual, the financial support to the family would be cut down. The financial support is continuous even in spite of his death. In that case, that support would be provided by life insurance. Not only this, life insurance can also help us to finance children's education or their needs in future. Let us try to put into an example. Kids studying today in first standard, just imagine what could be the financial resources required when he would be in 12th standard, maybe after 11 years. Considering inflation and cost of education after 11 years, we can start planning to finance our children's education need when he would be going to college or for professional and non-professional courses. Similarly, life insurance will offer savings plans for the future so that it is a constant source of income after retirement. A person who retires, there are two ways now you have to understand. One, the person who works in the government organization or in government services is but natural offered pension post-retirement, which may not be case in case of an individual who is working in a private company. So for the individual who works in a private company, he or she should plan the savings in such a way that post-retirement, whatever is the amount invested, you will get that amount monthly or yearly basis or quarterly basis till you survive. That is what is a plan, and that will be taken care of by insurance. Life insurance ensures that one has an extra income when your earnings are reduced due to serious illness or accident. I said insurance is nothing but a contingency which will take, for a contingency, a financial cover is given for a human life. And that contingency is in such a way that the financial loss which occurs during that period is being taken care by insurance. That is what we need to understand. And last but not the least, it provides other financial contingency and lifestyle requirement. If you have a good plan ready, and if you start investing today, you can definitely have substantial amount created for purchase your four-wheeler flat in cash if you plan your investment in the right way. These are few reasons for which you should buy insurance. If I know the reasons to buy the insurance, the second thing that comes to my mind is, now the question arises, who needs this life insurance? The first, primarily anyone who has a family to support and is an income earner. In this first statement itself, one word is very important, which is called as income earner. He is one of the person or the only person who earns income. That person needs to be insured. Second, in view of economic value of the contribution to the family, housewives too need life insurance cover. If I look at the first point, only income earner, that means only a person who goes out to work and earns for the family should be insured. But the second clearly specifies that women has a very high economic value in terms of their contribution to the family, so they also needs to be insured. If you want to analyze that, let us look at what we think. Just try to find out in our relatives or in our family how many of ladies are insured. It will be a very good eye opener, and tomorrow you can initiate that being a management student to create awareness and make every woman in a family insured. Last but not the least, even children can be considered for life insurance in the view of their future income potential being at risk. We are not at all clear what could be the future, what is the risk associated. So let the students also get insured, and maybe that student or a child get certain amount of money after certain intervals. Maybe after 8 years, maybe after 10th, 12th, maybe after 12th, the first year of the college, second year of the college. Every year if you plan, it can be planned in such a way that when the student goes in 10 years, he may get 1 lakh rupees. So that he get prepared for whatever is required for his preparation, will be available with the income of 1 lakh. Once he passes 12, maybe more amount would be required. I can plan for 2 lakhs. He goes to the first year, I need to pay the fee, 3 lakh rupees, 2 lakh is my fees, for example, whatever I have planned. But if you need to think of what would be the fees, what would be the hostel charges, what would be the examination charges, what would be the books, other contingency needs to be calculated. And just imagine first year when you're paying your plan properly, first year itself your child gets a substantial amount which gets or takes care of his fees, of the other things which he required, which father does not pay from the funds he has as of now. It is created and goes back to the child immediately. That is what we need to analyze in short. Every person should be insured. Let it be a earner, let it be a woman, let it be a children, for future perspective. That is what needed. Now, if you have a statement here that who all needs it, everybody needs an insurance. Next question that may come to your mind is how much life insurance is needed. There are various things which we should be aware of. The amount of life insurance, that is what we term as sum assured, will depend on many factors. Factors such as how many dependents are there, what is the size of the family, nuclear family or a joint family. If it is a nuclear family, maybe you will require less sum assured, but when you have a joint family, the sum assured would be very high. For example, there are only 3 people, nuclear urban family. Double income, no kids is again a concept. In that case also you may not require insurance. Income is there. You don't have kids. Whatever is available is saved. But there is a family which are two children, father, mother. Father is a own earner, then definitely the coverage should go up because he is going to take care of his wife, of the son. As number of family goes up, the insurance cover will go up. Whether you have any debts or mortgages. What is the amount of loan you have procured as of now? What would happen if suppose tomorrow an uncertain event happens? Who's going to pay it? Let it be a home loan, let it be a business loan, let it be a personal, every loan should be insured. So that whatever happens to an individual, once uncertain event happens, the care would be taken by insurance. What kind of lifestyle would you provide to your family? Just imagine you're spending today, and after 10 to 20 years, what could be your spending? What do you want your family to live like? Accordingly, you need to plan for some assurance. How much you need for your children's education? If you plan medical education today, 12 years down the line, after 12 years, your son will be, you are interested to make your son a doctor or an engineer. Just imagine what is the amount of fees you would require just for school. For the fees which you are going to pay, rest expenses are all different. Planning that, you can definitely think about what is the life insurance required. What are your investments? Where you have invested, what all you are going to invest in future. If your investments have been taken care of in future, only then substantial amount would be made available. So there are various reasons, various factors which we need to analyze when we are going to when we want to go for some assured in case of life insurance. Let us try to understand what we have covered. Recap. We have tried to analyze what is life insurance. We have tried to analyze why we should have a life insurance. We have tried to analyze how much life insurance is needed. We also tried to analyze who should be covered, who should have a life insurance. Let us try to understand and move forward with respect to what are the different types of life insurance policies. Moving to the next point, there are 7 different types of insurance policies. Term insurance, whole life insurance, endowment policy, money back plans or cashback plans, children policies, annuity plans, and unit linked insurance policy. Let us look one by one what those plans are. If you look at the first type of insurance, life insurance is termed as term insurance. Here what term is more important means, here this insurance protects the insured for a set period of time with in the event of death or total and permanent disability. There is no benefit is normally payable if the life assured survives the term. Now new policies have come wherein if you survive you are going to get benefit, that is you get cashback available. There are terms which are already available nowadays. Let us try to put this into a very simple example. For example, Vijay has done a term insurance of 1 crore for 10 years down the line. Means if your age is 25 till 35, he is going to get an insurance cover of 1 crore. During this 10 years, if anything uncertain happens, his family would be getting amount of rupees 1 crore. That is what is called as term insurance. But last statement is very important, that when I want to go for term insurance, it is payable. It is no benefit is normally payable. Means if I survive till 35, nothing happens to me, whatever is the premium I have paid will not be given back to me. That goes to insurance company. That is what is called as term insurance. Very simple to understand. Generally, each and every one should have a term insurance. At the younger age, if you go for term insurance, your premium is low, and as the age increases, the premium of the insurance of the term insurance will go up accordingly. So very important for us, term insurance is must. Younger the age, less is the premium. Increasing age increases the premium. That is related to term insurance, or is applicable to almost all the types of insurance. Let us try to second type. Second type of insurance is called as whole life insurance. As the word whole life here, the first we are talking about a term, a specified period. Now we are talking about a whole life insurance, guaranteed lifelong protection. And still you survive, your life is going to get protected. It pays out a death benefit, and this is an assured benefit for the family for protection against financial loss that can happen after death. It is also an ideal way of creating an estate for your heirs as an inheritance. Means if you die, you're going to give something to the family, and that the family is going to sustain for the future. That is whole life insurance. After your death, or after the person who has gone for whole life insurance, after he dies, only then his or her heirs are going to get benefited. That is what is called as whole life insurance. I suppose we are clear with term, specified years, whole life, after death you are going to get benefited. Let us go to the third type of life insurance, which is called as endowment policy. It is endowment policy, as the word endowment says, it is a saving linked insurance policy with a specific maturity date, like what you have an RD. Means you pay a certain amount and you are going to get that amount plus interest after specified maturity date. But in this case, being an insurance, unfortunate event by way of death or disability occur, the sum assured will be paid to your beneficiaries. Here the benefit is that in an ID, that is not recurring deposit, you put money every month, and on a fixed mature date you are going to get a return. But in between, if there is certain unfortunate event taking place, your recurring deposits will close, and whatever amount is available, only that amount you would be taking back. But in case of endowment policy, you are going to get benefited with what is sum assured, that is a rider which you take it. On surviving a term, the maturity proceeds on the policy becomes payable. If no unfortunate event takes place, whatever is the amount you have invested, that amount will be paid to you back on a maturity date. That is what is called as endowment policy. Similar type, there is another policy with life insurance, which is called as money back plans or cashback plans, as the name itself says. You invest and after certain period you get your plan money back. Under this plan, certain percent of sum assured is returned to the insured person periodically as a survival benefit. After a gap of 5 years, 2 years, 10 years, you get a fixed amount back. On the expiry of the term, the balance amount is paid as maturity benefit. Means there are two benefits you are going to get from money back plan. One is called as survival benefit, that is periodically you are going to get, and other is called as maturity value, that is on the expiry of a term, the balance amount is paid as maturity value. The life risk may be covered for a full sum assured during the term of the policy, irrespective of the survival benefits paid. Moving forward, let us try to understand the other, which is called as children policies. As the name says, these are the policies which are being carried out or taken for children, for the benefit of children, and parents can plan to get funds when the child attains various stages in life. You need funds at the various stages for children's education: 10th, post-12th, first year of the college, completion of the college degree, going for post-graduation. That is how for the marriage you need fund. You plan that amount, that is through children policies. Here, some insurers offer waivers of premium in case of unfortunate death of the parent proposer during the term of policy. What does it mean? Certain children policies has a rider. What does the rider say? If there is an unfortunate death of a parent or a proposer of an insurance, the child will get the same amount which was planned, because that would be taken care by the insurance company, that is the rider we have. Apart from children policies, there is also a life insurance policy which is called as annuity plans. These annuity plans are nothing but pensions plan. What is pension? Pension in short is a retirement provision because the benefit is in the form of regular income. Means post-retirement also you will get a fixed income on monthly basis, quarterly basis, half yearly or yearly. That amount is paid to you, which will have financial independence for the people who are trying to purchase annuity pension plans. There are two types of annuity pension plans. One is immediate annuity and second one is deferred annuity. The word itself is very catchy. Immediate, you retire, you get the entire amount. Deferred, that amount is paid in part. Let us try to understand what is the meaning of immediate annuity and what is the meaning of deferred annuity. If you look at immediate annuity, in case of immediate annuity, the annuity payment from the insurance company starts immediately. I said immediate, it is talking about I retire, next month I get a fixed income. Purchase price, that is premium for immediate annuity, is to be paid in lump sum in one installment only. That is what happens when we talk about immediate annuity. Immediate annuity is an insurance. For an insurance, you need to pay a premium. If you are trying to pay a premium, you need to pay a premium of immediate annuity once, whatever is the amount, according to what are you expecting. Similarly, let us try to understand what is called as deferred annuity. Deferred annuity is the policy the person pays regular contribution to the insurance company till the vesting age or vesting date. He has also an option to pay the premium once, but he can pay it in a month. The fund will get accumulated with interest, and the fund which gets accumulated would be paid on the vesting date, means after the retiring date. The insurance will take care of the investment of the fund. There are two options now. The policy holder has an option to encash 1/3 of the corpus fund on the vesting date tax free. Means if I have invested 100 rupees in deferred annuity plan, I will get 33.33 rupees the day I retire one time, and rest will be utilized for annuity pension which an individual is going to get on monthly basis. Means when you talk about deferred annuity, there are two things. I get one full-time payment and rest payment is in the monthly basis. That is what is the difference between annual, that is immediate, and deferred annuity. That is what we need to understand. Annuity is nothing but insurances which offer pension to the individual is called as annuity. Let us move to the next part, which is related to the unit-linked insurance policy which are related to markets. Let us try to understand what is ULIP, and after this we will try to understand what is the benefit of unit-linked insurance policy. Let us look at the definition now. Unit-linked insurance plans, or which are generally called as ULIP, are long-term investment plans which are a combination of insurance and investment. Let us try to put into. These are also a form of life insurance, but here you see there are three things which you are going to get benefit. You are looking as an investment, you are trying to look it as insurance, and you are also trying to look at as a tax saving. That is what is called as unit-linked insurance plan. Let us try to understand what the benefits. First, benefit of a life cover. Second, tax saving. Third, long-term wealth creation and flexibility to switch between the funds, like mutual funds. We can shift from one fund to another when we have ULIP in a form of insurance. The next point, let us try to understand if that is related to market, then what is the difference between ULIP and mutual fund? Is there a difference? If yes, then let us try to understand what is the difference between ULIP and mutual fund. First and foremost, ULIPs are regulated by IRDAI, that is Insurance Regulatory Development Authority of India, and mutual funds are regulated by SEBI, that is Security Exchange Board of India. In case of ULIPs, the primary objective is insurance plus investment, and in case of mutual funds, it is a clear objective only of investment. In case of ULIP, it is good for long-term investor, and mutual fund is good for short-term to medium-term investor. ULIPs are always long-term, but mutual funds have a good options available: short-term, moderate, and long-term. In case of ULIPs, it is having limited flexibility, that is with switching from one fund to another, while in case of mutual fund, you have a very high flexibility so that you can switch to any fund available in a particular market and related to AMC. In case of ULIP, you have a high entry load, and in case of mutual fund, it is less in certain contexts, and some of the funds do not have entry load available. Liquidity, it is limited liquidity because minimum 5 years of investment is required. It is highly liquidable since sell your mutual fund anytime except equity linked savings. Equity linked savings scheme you need to invest for 5 years. We try to understand that when we have tried to understand that when we try to understand different types of mutual fund. Tax benefit, all ULIP investment are qualified for tax benefit, while only ELSS, that is equity linked savings scheme investments are exempted or offers tax benefit. It is investment amount, it is generally determined by the investor and can be modified later. But when we talk about mutual fund, minimum investment amounts are determined by the fund houses. Switching of funds in portfolio, investors can switch by paying switching fees. Investors are not allowed to switch the funds. Your investment portfolio is managed by professional fund managers. Charges, a very high charges is collected by ULIP, and the charges are low management fee, and more if you look at expenses, ULIPs have high expenses while mutual funds are low expenses. Hence, if we talk about ULIP will provide insurance, investment and tax. But mutual fund will not provide insurance, will take care of only wealth creation as an investment will be taken care of, and maybe some of the funds will be applicable for taxation. With this, we conclude with what are the different types of life insurances. Thank you from my end.